In the previous video, we discussed why the house that you live in, the house that you've purchased as your own residence, probably shouldn't be viewed as an investment. But that doesn't mean that real estate is not a potential avenue for investing. Buying and living in a house, problem there is, there's many problems that we discussed in the last video, but the true problem there is that people buy houses thinking that they are an investment, and they really shouldn't think of it that way. However, if you think about real estate investing as a separate entity that is disconnected from where you're currently living, it can be a profitable venture, and we certainly want to talk about that some, okay? So real estate investing. Let me be clear here, when I talk about real estate investing, I'm not talking about flipping houses. Flipping houses is very speculative, incredibly risky, and generally speaking, not something that I would recommend getting involved in. But investing in real estate as rental property certainly is something that is a viable way to gain wealth over time. So the basic idea here is that houses can provide two avenues for profits. And that would specifically be the rent that they provide and the appreciation. Which, if you think about it, has some clear parallels to stock market investing. Stocks provide value in two ways. One through dividends and one through the appreciation of each stock share. Okay? So in regards to real estate investing, the rent is kind of like the dividends, and the appreciation is kind of like how stock prices grow over time. But of course, when it comes to real estate investing, the rent is going to make up a much larger share of the profits gained than dividends do with stock. And for that reason, you can view them very differently in terms of the cash flow that they provide. The payments that are going to be rolling in from rents will be quite high compared to what dividends offer with stocks. And that can be favorable in some situations if you really need that cash flow rolling in. So let's talk about it here a little bit. First, thinking about the rental value. In the world of investing in houses, if you look into it at all, you'll quickly come up with this idea of the 1% rule. And the 1% rule is basically the idea that you need to attain 1% of the house's value in rental income each month. If you can attain this 1% figure or higher, usually that's a good investment property. So for example, let's say that you buy a house for $200,000. Okay, that's the house that you purchased, and you've bought this specifically to be an investment property. Well, what you would hope to find is that you can rent it out for $2,000 a month. And obviously this is a simplified rule, right? It's not always going to be true. In some circumstances you would hope to get significantly more, and some you might be okay with getting less. It depends on a lot of other features such as property taxes, wear and tear, how likely it is that you'll find a renter, et cetera, et cetera. But this is a nice starting point, okay? If you can attain that 1% return, you're doing pretty well. And ultimately, this 1% return per month means that you would get a 12% return over a year, which obviously would be great, okay? Because not only are you going to get the rental value, but on top of that, housing values tend to rise over time. Of course, this is not like investing in stocks, right? It's not all about return because there's also expenses, okay? So when you have a rental property, you're likely to have significant expenses. Some of those expenses that you would probably have, obviously you're going to have insurance, right? Home insurance, which can be quite expensive. Usually it's more expensive than it is on the house you own for obvious reasons, right? An insurance on a home property that you're renting out is usually deemed more risky, and thus you have to pay more for it. You have property taxes you have to pay, upkeep, wear and tear, right? Which we could lump into upkeep if we wanted to, but you've got all these things you need to consider, and certainly the ones that are unique here that maybe you need to put more focus into is these last two: vacancies and failures to pay. And this is going to be different in different markets, okay? In regards to Milledgeville, a college town, usually not so hard to find somebody to live in a rental house because we know we're going to have this influx of students every single year. But in other markets, vacancies can be a big problem, okay? College towns is easy, partially because there's the influx of students, but also because everybody's pretty much on the same schedule, right? There's going to be people coming to school. Properties usually start renting out July 1st, the end of the year, it rolls back over, new students come in, so it makes things a lot easier there because you have people all on the same schedule. But if you're renting in a market like Atlanta, imagine you have your tenant suddenly announce that they're going to leave in February. Well, it's probably going to be hard to find somebody to fill that space right away. So you might expect that you have a couple of months of vacancies every few years at a minimum. And furthermore, you run into some tenants that aren't paying you. You could have attorney fees, trying to figure out how to deal with these people. They could destroy the house. There's lots of potential negatives, which makes real estate investing pretty risky, okay? Certainly there's potential profit, but the problem is, in my eyes, is a lot of people who invest in real estate put way too much of their wealth into one property. You can imagine somebody who has $300,000 in stocks, and then they buy a $400,000 rental property. They're putting a lot of their wealth into that one asset. And if they have problems, if the market collapses, or somebody does a significant amount of damage to that house, well, that's putting a lot of their eggs just in that one basket there, right? So it can be very risky. So once all the dust settles in regards to the gains from rent and the potential expenses, the bottom line is that real estate investors often look at something called the capitalization rate. The capitalization rate is the net annual income on the property. This is just thinking about rent minus expenses, divided by the house value times 100. Okay, that is the capitalization rate. And this is kind of like if you're thinking about trying to figure out a fair market value for a house, this would be a good way to think about it. Look at capitalization rates for different properties, estimate those, and see if you can find one that's doing a little bit better than the others when it comes time to buy. Just to give you an example here, since this is math, you will see something like this on the quiz. Not so hard though. Let's say you have a $168,000 house that you have purchased. It's rented for $1,500 a month, and you expect to have expenses of $600 a month. Now those expenses, that might seem high, but you got to realize when it comes to a rental property, a lot of times the expenses all happen at once. So if you imagine having a rental house for just a year, you would think, expenses would be low, just a few $100. But you got to recognize there's going to be major disasters every so often. Like if the AC completely craps out, well, replacing an AC, replacing a furnace, that can be $10,000. Or if you have flooding problems inside the house, replacing those issues that have been messed up, replacing those problems can be incredibly expensive. So you might go a few years with very few expenses, and then you have huge expenses for one given year. And so the bottom line is you would just try to estimate those things going into it, right? Older houses tend to need more upkeep, newer, less upkeep. So you would estimate the capitalization rate based on expected expenses and expected rent, okay? And so what you would find is, for example, for a house like this, the capitalization rate would be, all right, see the cash flow here, $1,500 coming in per month, $600 going out per month. So that would be $900 a month in net income. So we're going to annualize that, right? Just multiply it times 12. If you're getting $900 a month in positive cash flow, multiply it times 12 to get $10,800. And so we might expect a 6.43% capitalization rate. So that is kind of like the dividends once you consider the expenses, okay? And indeed, when it comes to taxes, this is primarily how it would be taxed. In regards, we'll get more into rental value here in a bit, but you can sort of think about it, this 6.4% as being the taxable part of the return that you have here, okay? On top of that, on top of rent, you would also expect to receive house appreciation. And this is just merely the idea that houses tend to go up in values over time. We said in the last video, it's on average in the U.S. about 4.1%, okay? So that might be what you would expect. Now, everybody wants to get wrapped up in predicting this, but it's hard to predict, you know. Housing prices in Atlanta have been rising much faster than they have in Milledgeville. There's really no way to know for sure that that trend will continue. So we might just say 4.1% is a good estimate for anywhere in the U.S. So you can kind of imagine if you add these two values together, you get 10.53%. That might give you a reasonable estimate of what sort of return you might expect on this house over the long run. Obviously, again, that's a simplification, but I would argue if this is truly the way you estimate things, then to me, this return is not adequate when you consider that the stock market on average returns about 10% per year, okay? But nonetheless, there may be other reasons why you want a rental property. You might want to diversify away from stocks. You might be speculating that house appreciation will be much higher because maybe you know something other people don't. So it's hard to say for sure what's a good and what's a bad deal. But that's the math behind it. That's the logic to the math. So you can invest in rental properties. Things can get pretty complicated if you want them to be. There are professional real estate investors, of course. You might also engage in something called house hacking. Look that up, house hacking. That's the idea that basically you buy a house for you to live in, but you rent out a few of the bedrooms in the house to someone else, and they essentially pay the mortgage for you, and you live mortgage free. So that's another way you might basically turn an idea, which is you need some place to live, into something that is monetarily favorable for you. Regardless, what I would make sure that you understand is that real estate investing is work. Stock market investing is not. Okay? So if you offer me right now a 12% return in real estate investing, if you could promise me that, that still might not be worth it, because keep in mind, renting out a property is very time consuming. It's hard work. I know this because I have a rental property that I'm currently selling right now because I'm tired of dealing with the work. It takes quite a lot of time to deal with problems. You know, your tenants call you up and they say the toilet's not working. You got to figure out a way to fix that. You can do it personally or you can hire somebody, but regardless, it's going to take time to do that. So it's very different from stock or bond investing, which are passive, which you're not actively involved in. So what if you want to invest in rental property and real estate property, but you don't want to be actively involved? You don't want to be doing the work. Well, you might look into something called a REIT, R-E-I-T. This is a real estate investment trust. Basically, you can think of a REIT as kind of like a stock market version of real estate investing. A real estate investment trust allows you to passively invest in rental properties or commercial properties or land. There's various types of REITs that you can invest in. When I say passively here, I'm not using the passive versus active argument where we're talking about picking and choosing stocks. What I mean here is you're not actually having to do the work of maintaining the properties. So it's passive in the sense that you do nothing other than own the shares, okay? So you could invest in REITs. The return on REITs has been actually pretty similar to stocks over time. So if you invest in REITs, you might expect to get 10% return. It's a little bit harder to know for sure what the average return on REITs has been because it's segmented into so many different varieties. And a lot of REITs don't stick around for a long period of time. They get wrapped into another company. And REITs themselves may be owned by a parent company. For example, Berkshire Hathaway, right? Warren Buffett's company, Berkshire Hathaway. They actually own a company that just does REITs. So their stock market price includes that REIT inside of it. So it's all connected to the financial market in general, which sometimes makes it hard to separate, okay? So you might be wondering, why have we not talked about this more? Because clearly there are potential advantages of having REITs, investing in REITs, and we're just now bringing these up. So some of the investments here, buying a house is very expensive, right? But investing in real estate through REITs can be cheap, all right? Just like you can buy one tiny share of a company, you can buy one tiny share of one of these REITs, which allows you to invest in the real estate market. It's also going to be more diversified than owning an individual property because you can basically invest in REITs that cover the entire country or other countries. I don't know if there's any that cover the entire world. I doubt it. But it allows you to invest more broadly. So if I'm going to invest right now in real estate, I'm probably going to invest in Milledgeville because it's going to be really hard for me to manage a property far away. But through REITs, I can invest in properties throughout the country, right? So it allows you to diversify a little bit more. So those are obvious advantages. It also provides a solid return in line with stocks. So given those potential advantages, let's think about why we don't talk about this more. I bet a lot of you have never even heard of these REITs. So why do we not talk about these more? Well, a big reason is investing in total stock market index funds, right? These are the index funds that we talked about a couple weeks ago, right? So if you're investing in the entire stock market through passive index funds, they basically already include real estate. Keep in mind, these REITs are really just companies, okay? In other words, if you own REITs, what you're doing is you're paying a company to manage properties. Those properties themselves are publicly traded and are already invested, are already pieces of these index funds. I mentioned before that Berkshire Hathaway is a conglomerate that you can invest in, and it itself buys bunches of companies, okay? So Berkshire Hathaway already owns companies that manage REITs. So if you own stock in Berkshire Hathaway, you see, you already own REITs. So in regards to purchasing REITs, you don't have to go out and specially purchase those to own these. As long as you have index funds, you're going to naturally be invested in REITs. And furthermore, even companies that aren't real estate investment trusts, even companies that aren't specifically organized in real estate, still have property. So if you're investing in Amazon, Amazon owns property. So you're still investing in real estate in a way, right? You're still investing in land, you're still investing in buildings because Amazon itself owns property, okay? So it's sometimes superfluous to buy REITs because if you're investing in index funds, you already own real estate, okay? So that's a potential disadvantage. And then I would say a second one here, and this is the reason I really don't like talking about this very much. I don't always include this in my personal finance classes, in fact. The typical U.S. citizen already has too much real estate. And maybe I'm misspeaking here when I say the typical U.S. citizen. I don't really mean the typical U.S. citizen. I mean the typical upper middle class U.S. citizen, okay? What an average American does, people watching this video, myself, I'm probably guilty of this. The average American will buy a house and it will be a big share of their overall wealth, right? You can totally imagine somebody who has a net worth of $600,000 and they own a $500,000 house, right? So they're already going to be super tied into real estate. They've already got too much of their money tied into real estate. So for those people, it doesn't really make sense to invest in REITs when they already have stock market funds in real estate and they already own a property that is a significant amount of their overall net worth. So for those reasons, REITs may not be something you want to spend a lot of time looking into. But perhaps they are. It's definitely something you would want to know about if you're going to teach other people about investing, because invariably at some point in time someone will ask you about REITs. So to tie this up and to close this out, I just want to mention taxes a little bit. Taxes for real estate can get actually very complicated, much more complicated than anything else we've been dealing with, and I don't want to expose you guys to those complications. I just don't think it's worth our time right now. It's not worth the brain space it would take up. So in regards to rental income, this is that cash flow, right? The money that's rolling in. Rental income is taxes income. Right? Now, obviously, you're not going to be paying Social Security or Medicare taxes on it, right? We talked about this in the prior video. Social Security taxes and Medicare are taken out of typical earnings that you receive from employers, okay? Any investment earnings that you receive are not taxed as income. So unless you have started your own real estate company, right? Unless that's your primary source of income, you will not pay Social Security or Medicare taxes out of this, only income taxes, okay? So the rental income will be taxed as income, but you can deduct expenses, which is really nice, including, if you recall, mortgage interest. It turns out that the mortgage interest is handled differently depending on whether you live in the house or not. If it is a house that you are renting out for profit, mortgage interest is an above-the-line deduction, which means it is always deductible. That's quite good, right? That's very favorable. So, if you're paying 4% on your mortgage, you can deduct any interest that you're paying, which often makes rental properties a good deal, especially for people that are very wealthy. People that are in a high tax bracket often have more value out of rental income because of the specific advantages it provides in terms of how it's taxed, okay? So the wealthier you are, oftentimes the better it is to invest in real estate. The sale of the house, right? We talked about how real estate investing has two ways to provide profits. One is the rental, and then the other is through the appreciation of the house itself. The sale of the house can be taxed as capital gains, or income, depending on the specifics of your sale. If you're just truly investing, you're going to be paying capital gains taxes on it. Wait. Sorry. That's totally wrong. Let me replace that. There we go. Taxes, capital gains, or not at all. Okay, and again, this is what I'm talking about when I say that it can be a really good way to invest when you're wealthy. Because the higher your income is, the higher effective tax rate you pay, and the higher marginal tax rate you pay. So the more cognizant you are of trying to avoid taxes, the higher your income is. So if you live in a house at least 2 of the last 5 years, I believe we've made this proclamation before, you will not be taxed at all. Again, if you live in a house 2 of the last 5 years, you would not be taxed at all. So you might think, you're living in a house right now, and you've been living there for 6 years. You can then rent it out for up to 3 years and then sell the house, and you won't pay any taxes on the gains from those houses, okay? So living in a house can be a strategic way to reduce your taxes. And this could be a big deal, right? Let's say you get a rental property when you're 30 and you don't sell it until you're 70. Well, you might decide to move into that house for a couple of years, live there before you sell it to avoid capital gains taxes on it. If you have not satisfied this first part here, if you have not lived in the house, well then it is taxed as capital gains. Which for a lot of people will be at the 15% tax rate. And you just pay on the profit, right? Just on the profit of the sale of the house. You can, at this point, and this is where part of the way where it gets kind of complicated, you can take the profit that you generated and use that to buy another property, roll it into the purchase of another house, and avoid taxes. So people who are real estate investing will often try to lump sales and purchases together. When they're selling one property, they would pay taxes on it, but they take that money and use it to buy another property, and the IRS has deemed this as not a taxable event when you do this, okay? I mentioned I'm selling a property right now. It's closing in November, which is several months from now still. The reason is because the person who's buying it is selling another property, and they are doing just like I talked about there. They are rolling the sale of one house into the purchase of my rental property, okay? It actually gets much more complicated than this. I'm letting on, but I'm not going to get into it. Look into capital depreciation if you want to look more into the housing market and how it is taxed. REITs often are also taxed in sort of a complicated way. REITs, kind of like stocks, but more complicated. Probably no reason for you to know the very specifics of that, so I'm not going to go into it now. But if you're curious, you can learn about REITs. You can learn about how these things are taxed. And certainly if you want to go into real estate investing, you really want to know the tax code, because that's one advantage you have over other investors, okay? You can know the tax code when other people don't. As a last note here, I just want to say one thing. Keep in mind, we talk about stocks. We talk about stocks as being an efficient market. What that means is it's hard to predict the stock market because everyone's trying to predict it, all right? If everyone expects the stock market to go up tomorrow, it will already go up today because people are anticipating the future. The stock market is forward-looking. All of that logic really breaks down when it comes down to housing. The housing market is not efficient. What I mean by that is some assets are undervalued, some assets are overvalued, right? Milledgeville is a really good place to invest in real estate, so why doesn't that go away? If Milledgeville is such a good place to invest in real estate, you would think people would come down to Milledgeville, buy up the properties, drive up the prices of housing, and then it would stop being such a good place to invest. That's what happens in the stock market, right? When some stock is undervalued, people buy it until it's no longer undervalued. The problem is, people can't just come to Milledgeville and start buying properties most of the time, right? It's hard to do that. It's costly. You might not even know about Milledgeville. If you're somebody living in LA, you might not know that Milledgeville even exists, and you might not know about an individual house for sale in Milledgeville. So what that means is there are deals to be had in real estate investing. So it is about learning the market. If you're going to invest in Milledgeville, you'd want to spend a bunch of time learning about the Milledgeville market, because you can use that information because other people don't have that information. Very different from stocks. Learning information in stocks is really not very useful. Just broadly diversify. Buy as many stocks as you can. Housing, totally different story. So what that means is if you want to get involved in real estate investing, you want to do a lot of research and learn before you start putting your money into these properties. And I'll give you an example of that right now. Atlanta versus Milledgeville.
This is what I was talking about when I referred to how markets are not perfect in housing. So this is Zillow, this is Atlanta, and I just kind of picked out a rental at random here. So this is a house that's being rented for $3,400. Note that it's currently listed for rent. That means it's not rented, so it's sitting there not gaining any value most likely. So you can see it was listed at $3,400, and you can go in here and look at the history for this house, and it sold back in 2018 for $675,000. So really far away from that 1% rule. Whereas if we look at Milledgeville, I kind of did the same deal here. I just sort of picked out a house. This house is rented for $1,100. And this house was sold for $90,000 a couple years ago. So you can see this house is going to exceed the 1% rule. This is something that I typically see is that in big cities, a lot of times the rent values are less than what you might expect. And for college towns, they're often good rental properties in terms of the potential value that you get out of them. There's a couple reasons for that. One, college students are more likely to tear things up. But another reason is simply the housing market in Atlanta is expected to increase over time. So people are speculating that housing values are going to go up. So they're putting more weight into house appreciation and less into rental appreciation. Well, so what does that tell you? Well, what that tells you is if you're going to buy a house in Atlanta, that's not as good of a deal because rents are relatively cheap. Whereas if you're thinking about a market like Milledgeville's, you're often better off to buy relative to rent because the rental values are overvalued, essentially because there's so many students. And this just goes to the idea that markets are not efficient in the rental market. It's tough for somebody to come down to Milledgeville and find rental properties and go through all of that effort, maintain upkeep, etc. It's not like owning stock. So there's no reason to necessarily think that rental values will reach a constant state throughout the country.